Hello everyone. Welcome to this Friday webinar. My name is Kamal Manocha. We have Mr. Arun Subrahmanyam from Ampersand Capital, and today's topic is very special. We are wanting to decode the budget and want to understand from Arun Subrahmanyam, over this 1 hour of conversation, that what does he read out of this budget? What is the interpretation of this budget for economy and equities ahead in year 2024? We have seen elections like never seen before. A lot was kind of expected, but I think a lot got delivered as well. But the budget is looks to me very bold, but I do not want to bias, by speaking my views about the budget to begin with. But yes, I would like to kind of, spend time with all of you today on this webinar by kind of taking your questions also in the second half once we have done our set of conversation with Arun. So kindly kind of share your questions, whatever disappointments in budget you see or kind of opportunities you see, do share all that on the chat. I will kind of try and take everything, in this webinar. Welcome, Arun, to this Friday webinar, at PMS AIF WORLD platform. We have had interaction with you before also. This is the second interaction that we're doing, and absolutely my pleasure to kind of, have you here.
Yeah, pleasure is all mine, Kamal. Thanks for inviting me.
So let's maybe, begin by hearing from you. What are your top level sentiments and thoughts, when you kind of attended the budget, or now it's like already 2 days. We have already seen the market reaction on that day and, after 48 hours. But yeah, what are your views, the top level views to begin with?
Yeah, so obviously, I think the market part, the people who are actually attending this webinar will be more interested in what it means for the market. By and large, the budget is actually quite a balanced budget. I mean, obviously, there were concerns that the government might just go towards giving a lot of freebies, given the political compulsions which it was under. That hasn't happened. So to a large extent, I think it's been a kind of a balanced budget where fiscal prudence has been the main the focus of the government, as well as looking at how India is going to progress ahead in terms of economic growth. So it essentially tries to balance growth and fiscal prudence. That is my general opinion. Having said that, obviously what happened on the budget day, we all know. The market obviously was focused on certain taxes which were levied, especially on capital gains, which we'll probably discuss as we move forward. But overall, if you look at it, I think it's been a budget which has been handled quite well. And to that extent, I think we are quite pleased with it. Having said that, the capital market itself will have to now live with the fact that equities will be taxed additionally, and also live with the fact that it is more attractive to become long-term than to play short-term. So that is the reality, and that one has to adjust to. So that would be my opening comments for the time.
Sure. Absolutely fine. So we'll maybe further deep dive into this over this conversation. May I know from you, what is the one biggest positive that you see in this budget, equating it to the growth of equities over, say, this year from here onwards?
Yeah, see, actually, it's a very strange thing when I say that there is not something extremely positive for equities, but what is positive is that it is actually positive for the country, and eventually it will flow into equities, right? So the most significant announcement which the government has seemingly made is on the job creation, which is something which we had actually touted in also a presentation that is what we think the government will do. It has looked at job creation, especially at the low end level, by incentivizing both the employer and the employee to get them to not only get employment, but also to get them skilled, at least at the lower end. And it obviously is going to benefit a lot of new entrants, first time job entrants for the first timers, and therefore it should be eventually good for India and for basic consumption is what we think. But having said that, the other good thing is that the government has not tinkered with the capex spend, which the market was in some sense fearing. So they have left it at where it stood at the interim budget, toward 11.1 trillion. Considering the fact that we've already finished about 5 or 6 months of the fiscal, which essentially means that you will see this starting to kick in towards the second half. Having said that, we think a lot of the capex going forward is not only going to be supported by government, but it also will be an initiative of the private sector. So we see a combination of both private and government supporting the capex. And of course, as I said, the consumption-led benefits will have a trickle-down effect over time.
Sure. So if I, want you to now cover what are those top 3 sectors that now, as a fund manager, you look forward to in maybe adding on to your portfolio or increasing weights in your portfolio, given the kind of budgetary allocations that have been announced, and as they will kind of impact these sectors. And if you could take an example and explain that will be very interesting.
Yeah. So, I mean, I can break it down to 3 or 4 parts. I mean, one, of course, is the fact that there were the instant beneficiaries which market discounted the day the budget was announced, which happened in the case, for example, specifically like ITC and those kind of companies, which saw instant benefit, and because there were no taxes. So those stocks obviously did extremely well, but it doesn't really change our view on that particular stock or the particular sector, because the rest of it still remains the same. If ITC were to has to be bought or has to be held, it has to be held for reasons other than the fact that it was not taxed with the budget. Essentially, the unlocking of the hotel business and also the fact that the FMCG business will drive its future earnings going forward. So essentially, that budget, what the budget did, that one-time kicker, that's already over. So that is not something which would matter as we speak. The second one was, of course, in terms of the jewelry sector, which obviously saw some kind of tailwinds, and it would certainly help that sector as a whole. Some of it has already been discounted, as we've seen in the last few days. But going forward, I think you will see that tailwind continuing to support that particular sector. Then there are sectors which actually somehow have taken a slight hit because the markets felt that the capex-driven sectors should see shift away from those themes and get into consumption, which is not our belief. But having said that, we also have recognized the fact that some of the capex themes which did do extremely well. I'm talking about the non-energy transition related themes like defense or shipyards and all those kind of themes, railways. These are kind of capex oriented themes that were already overpriced, and they were actually it was a good excuse for those sectors to start to correct and to move away from them probably to some of the consumption led sectors. But having said that, we don't recommend, or at least in our case, we have not done any major shift from capex to consumption because our theme in our fund is continuing to be dominated by capex, which is oriented towards energy transition. So basically anything which is to do with power or its ancillaries, or we continue to support and continue to stay invested in. And we think it's a good space to be in for the longer term. Consumption, like I said, it's not something which the budget has made a big difference. But in natural course, I think probably one would have probably had to do that because of the fact that valuations had started looking little more attractive, and at the margin, the consumer space would probably see more traction. So that kind of minor shift one could have made. The one sector which actually has done quite badly, I don't know, I have not seen the individual stocks, but has not done very well, is the real estate sector, because obviously because of the fact that the government removed the indexation, So there was this big concern that the speculative element in real estate companies or in real estate will go away, and the fact that it is no longer such a great investment to be investing in real estate. So that was one, and that is probably the reason we've seen some of the real estate stocks not do well. Our opinion is not. I mean, we are not so negative on it. Actually, we think, in fact, some of the first time. In fact, it doesn't really make a difference to people who are buying real estate for the first time, right? That demand is anyway going to continue to be there. Yes, the speculative element will come down, but ultimately, for people who have held real estate for a longer time, it is still it's a positive to be in this sector than not to be. And also the fact that if you're actually buying and selling real estate and buying another real estate, it doesn't really affect you, right? I mean, it doesn't affect the price. So the demand, I don't think it's really good to see a major decline or a slowdown in terms of growth potential. So that is one sector we think we like, but not as much as probably we did a few months ago. And the fourth thing, of course, is not related to the budget at all. I mean, if the budget were not to be there, we would still continue to pursue the themes which we had pursued prior to the budget, and that hasn't changed.
Sure. Capital gain tax to 12.5% from 10 is like something which markets have, I think adjusted well. But the short-term capital gain tax going from 15 to 20% is something which is like, I think, disturbing investors, especially the PMS investors and AIF investors versus mutual fund investors. Since you also kind of have your own money with high skin in the game in your own AIF, what is your investor point of view? I will maybe understand your fund manager point of view subsequently, but what is your investor point of view here?
Yeah. So obviously it will. So one has to adjust. Like I said at the beginning itself, one has to adjust for this new reality in equity investing. I mean, in 2018 or 19, when the first time the LTCG was introduced, markets did get adjusted to it. I mean, initially they were obviously upset that this has happened, but now obviously you've gone 10 has gone to 12.5, which essentially means that when you invest in equity to that extent, that plus the surcharge, of course. So to that extent, your returns are going to come down, and it is obviously going to hurt short-term investors. So you'll probably see, I don't think it's going to matter much to the speculators, who obviously will continue to buy and sell stocks, and the tax treatment is very different from what it is to investors who invest for the short term. So for investors who invest for the short term, it obviously is going to matter, because you really can't churn your portfolio on, and it's too heavy. The tax, including surcharge, is very heavy to do that. So one has to automatically get adjusted to two things. To first invest in companies which have long-term growth prospects. And when we say long-term, it is very clear now that you cannot get into short-term cycles. You have to look and not get into momentum for the sake of getting into buying or selling stocks. You have to get into some themes which are essentially long-term, and then say that, okay, once you have done that, we are now willing to pay that additional tax and live with that.
Sure. Now I would be keen to understand your fund manager's point of view, but before that, if you could maybe share about your churning in Ampersand Capital, say average churning in last 5 years, and what has been average churning, what is the churning in last year? Because last year was like relatively different year, and then we can understand further.
Yeah. So typically, I mean, I don't know how to give you a 5-year number, but typically what has happened is that whenever there are major events, there is a churn. It has happened in our portfolio also, and it probably happens in others. But when we look to invest in anything, we don't look to churn. I mean, we are a long-only fund, and we obviously look to invest for the themes or sectors where we have visibility for at least 2 to 3 years. But some churn is necessary, A, because you've made a mistake, that could happen in a few cases, and B, when the environment changes or the regulations change or something like that, then you have to adjust to the reality. Or in some cases where stocks do so well, like they did in some cases last year, then a churn is inevitable, right? So in our case, our churn rate has been somewhere 20-25% or thereabouts, and it has differed. And like I said, you saw some churn in our portfolio between April and June when we made this small shift. When some of the overvalued stocks, we had to take profits and try and get into some stocks which had not done well. But otherwise, like I said, our average churn rate of about 20-25% is where we continue to stand at.
Sure. So does this, increased taxation kind of, I would say, motivate you or provoke you or make you think of investing into mutual funds versus an AIF?
Okay. No, see, the reason why people invest in AIF is because the fact that, yes, it is regulated, but not to the extent the mutual fund would stand, would be under scrutiny. In the sense that, we are a multi-cap scheme, but we could very well be a small cap fund. We can have 30-35 stocks, or 50 stocks in the small cap portfolio. But we have run it like a multi-cap scheme with changes being made to wherever we are more growth focused. So wherever we see growth, if growth is going to be in smaller names, we will be there. If it is going to shift to bigger names, also because the bigger names have not done well and the valuations are looking attractive, we'll move there. So we have that flexibility. So to say that we look at mutual funds versus AIFs, I don't think that advantage will go away. That will continue to stay with us. And of course, within mutual funds and AIFs, the better run mutual funds and AIFs will continue to get that advantage and continue to get active interest. So yeah, that would be my response to you. Did I miss anything? I don't know. I'm forgotten.
No, sure, absolutely fine. So, now apart from listed equities in the budget, there is this standardization of taxation done for unlisted equities also, which was like earlier, 20%. Now it's also reduced to 12.5%, similar to kind of listed space.
Yeah.
With a 2-year as a time period for kind of to qualify for long-term capital gains. Do you think it will kind of promote you? It will kind of make you add some of the unlisted securities in your AIF, because as an AIF, you can invest in unlisted securities also up to a certain percentage?
Sure. So, the two things here. Of course, one is unlisted itself, and second is unlisted which stay unlisted, right? Earlier, when we were looking at exploring this space, we were doing it primarily because we look at unlisted and which will eventually get listed. But now that advantage goes away, right? Obviously, once you get listed, you are subject to the taxes of the new regime. But coming to the unlisted, which stay unlisted, again, you have to be a little careful here. I mean, there are considerations in terms of, it has to have an exit. You have to have an exit strategy, a clear exit strategy, whether in terms of liquidity or how that's going to be done. So we are open to doing it, but so far we haven't done it in the sense that we don't want to be an unlisted for the sake of being unlisted. But we are obviously now open to that idea.
Sure. So far as the taxation related, I would say announcements are concerned, whereby the taxation has been increased in long term and short term. Is this in line with your expectation? Were you expecting this, or you are not expecting this?
So the things, I mean, when I said we were expecting, obviously you hear about it, read what's in the papers, what's happening, and you watch news channels and things like that. So the one thing was very clear, the way the exchanges were sounding out, and SEBI was actually sounding out, that there will be some kind of element of taxation or some kind of impact in terms of the futures and options. That we were very clear that will happen. That of course doesn't affect us or doesn't matter to us. But having said that, the fact that long-term capital gains, the capital gains was going to be tinkered with, was a hope that it would not happen, but not an expectation. We did not say that it will happen or not happen. We knew that there was a possibility that it could happen, but we did not obviously know that it will happen. the way it has happened, in the sense that obviously, like I said, the STCG going up the way it by the extent it has, we didn't expect that. Again, while I don't want to, like I said, it obviously it's a good, in a way, it's a good thing that equity investing, which always was considered to be an asset class where you have to invest for the long period, it probably will force more and more people to do that, and I think that's a good thing. In our portfolio, for example, just like I said, if you look at a proportion of long and short term, what would be long term and short term as of today, as we stand today, it will be probably 1/3 short term and 2/3 long term. Ideally, we would like it to make it 80-20 or something like that. Now, of course, probably we want to make it as much as possible closer to 100%. That may not happen, but it obviously, I think it's a good thing that people will invest more and more for the long term, or think at least.
So when you kind of would have kind of read this budget or heard this budget on that day until now, do you see what you were expecting from a kind of a BJP government this year? It's like in line with that, or you think it is in fact bolder than what you were expecting, or it is like weaker than what you were expecting?
So if you look at this, if you remember what happened on June 3rd or June 4th, what is the date? I don't remember. June 4th. Expectation was that because of political compulsions, the government will take this route of fiscal sops, freebies and things like that. But to that extent, I think this budget has the BJP has stood its ground. It's not really altered from where it was what it was doing earlier. So to that extent, I think it has been a positive surprise. I mean, obviously, there were some political compulsions where the government had to favor certain states. That is okay. That is part and parcel of what had to be done. And even the one which I said is the most exciting part of the budget was the fact that the government has looked at long term in terms of creating new jobs. It's obviously easier said than done. It's something which the government will have to work towards and execute, because that's not just because it's been made, the announcement has been made in the budget, that doesn't mean it's happening from tomorrow. Because it's not a mandatory thing. Of course, the employers will have to will also have to be on board, and they'll have to start volunteering to accept this. So from our perspective, I think the BJP has done a good job. It's not something which they have wavered from what they were doing in the past.
There have been, perceptions in India and for Indian economy that we pay so much taxes as middle income people, and then we do not get much of social security or infrastructure like we see in the West. Yeah. Now, I'm sure if you could kind of give, based on your experience, a parlance or kind of your perspective, how do you see this particular perception changing? Or you're also one who kind of believe that yes, it's like still there are a lot of issues. We talk a lot. There are tall promises, but at the same time, like growth is going to be slow. It's like stock market maybe is buoyant and cheering, but that doesn't mean on ground we see really that development is happening, and then whatever taxes we are paying are actually going to help us see a better future, for our next generation, and maybe actually India is actually improving.
So this is a very philosophical question, in the sense that we've been 75 years since independence, and the fact is that our tax to GDP is still extremely low. I mean, so many segments are not taxed because due to political compulsions and what have you, and there's obviously so much of tax avoidance, and so obviously it's a slow grind. And at this point in time, what's happening is whoever cannot escape paying tax, where tax is either deducted at source or something like that, and those are the ones who actually, or even in this case, for example, I think if you look at capital gains, the way taxes are going up on capital gains, it's because there is a perception, and it's not a perception, it's a reality that investors have done well. and it's because they have done well, they can pay taxes, and that's the reason why the LTCG and STCG has gone up, right? So that's a reality. So you're going to have this is going to happen as long as you have a situation where your tax to GDP does not actually increase to a level where you are able to then start taking these decisions to start cutting taxes. So until then, I don't think you're going to see that change. So as far as the middle class is concerned, all of us probably are part of that. I mean, I don't think. I mean, we adjust to whatever comes our way. So that's how I look at it. But I think directionally, I think we are going to get to a point where, like I have probably said in some other forum, that we are getting because of fiscal prudence and fact that governments are getting richer now, at least at the central level. State levels, there are still issues. A lot of development can be done, and in terms of improving social security infrastructure and things like that. But that will take time. So Modi ji is given a time till 2047. Some of us are not going to be there till then, but we can just hope that happens.
Sure, a lot has been discussed, in the fund management industry over last, I think, 3-4 years about manufacturing sector. Like India is shifting from being a services-driven economy to now manufacturing-led economy as well. And a lot was talked about it, last year in the last year election manifesto. And then I think a lot of reforms have also taken place. In this budget, do you see that, is kind of again taken ahead from here, or that was something like which was an advantage to us because of China weakening, and now China is again kind of become strengthening, and then it was like a trade, an advantage, but now not anymore. As a fund manager, how do you see that?
See, all these things are actually, India becoming a manufacturing destination or trying to do what China has done in the last 30 years, obviously is not going to happen in the next many years. I don't want to put a number to it, but it's not going to happen. But I think we have started. I mean, at least we've started the process of actually trying to get to a trend which is going to be moved towards manufacturing. I mean, in whatever way that it could help. Fiscal discipline will help. I mean, if at least you'll probably say you probably at some point in time see our sovereign ratings starting to improve, which obviously means that cost of funds will get cheaper. So you'll find that setting up these manufacturing bases and spending on or creating infrastructure or spending on infrastructure, that will get cheaper. I mean, to do all that. So that whole phase is going to take time. I mean, today we still, capital for us is extremely expensive. It's a scarcity and it's an expensive resource. But over time, it should get better unless you kind of see some major shift in political stance or something of that sort. So that's where we stand at this point in time. Yeah.
So your portfolio has allocation to manufacturing segment, and how much percentage, if so?
So yeah, so it has. I mean, I don't have a split between manufacturing and services at this point in time. I'll have to add it up, but we have a fair share of manufacturing. Most of it actually we added in 2022. The shift, if at all you say, the shift which was made from being a purely consumption and financial services, banking kind of stocks, we had moved into manufacturing in 2022, and that has actually yielded some returns. And we, like I said in the beginning itself, a lot of our investment in the manufacturing sector comes through the energy space, and that is something which we are extremely bullish about.
Sure. So first half of this year, has seen massive returns already in equities, and given your again 30 years of experience at this juncture, I know let's not talk about valuations because that is something which has a sentiment and liquidity driven aspect to it as well. But let's talk what you think, like in first half of the year, has gone by with a full cheer. One, because of elections, and then second, because of now budget being very positive and optimistic. And maybe now here onwards there could be another driving factor, which is like FII coming back if interest rates start to come down in the US. I do not know. I want you to kind of address what is your understanding of how will second half of this year be from here onwards. I know it's very short period of a time, but because we have to kind of try and analyze mathematically or maybe objectively from the point of view of our audience and people who will watch this webinar as a judicious reply to those investors who maybe are sitting on liquidity and they're trying to kind of take a very wise decision of whether they should be investing at these levels or kind of one should wait a bit and second half could give some time correction or some price correction.
See, first of all, we should not be doing this first half, second half, in the sense that going by what most experts said in the beginning of the year, we have given 2 years returns in 6 months, right? Most people said it will be very low returns this year, and next year things will pick up and things like that. We've already given that kind of return, especially if you are holding mid and small companies, and especially the right mid and small companies. So that's happened. So second half, again, let's go. Since you asked the question, I have to answer it. Second half, if you look at it, there's another event. I mean, there's obviously the US election, right? The US election, there will be some nervousness. I mean, not just the US and what they do, what the stance will be. So there will be some nervousness there. Some sectors which are positioned to the global, to the external world, like pharma or IT, these kind of companies will have, there'll be some nervousness towards that time. But that's very sector specific. So if you come to the domestic situation, the sector, if you go by valuations, like you obviously said, valuations leave very, very little room for any kind of error. The first quarter results, we've seen the IT starting to look better. Banks have done badly, and everybody's arguing, giving you the fact that valuations are very attractive now, and probably the cycle is bottoming out. But the fact is that credit costs were higher than what was expected, and most banks have not done well. The regulations are not favoring them. So it's very difficult to make a call as to whether banks have bottomed out and that's where they will do well, or they will continue to not do well, and therefore the nifty stocks will continue to underperform the broader market. As far as we are concerned, we think there are pockets in the market which still look attractive. I'm not talking from a valuation point of view. I'm talking from a growth perspective. Because quarter one has to remember, there have been the so-called manufacturing sector, not so-called, manufacturing sector itself has seen disruptions because of elections. And some of them have seen order books being pushed back, workers not being available to execute projects and things like that. So that will start to catch up in the second half. So I don't think we should do badly. We should not do badly. Now, I don't have a number to it. We should not do badly. So as an investor, you have to look not just at the second half, but beyond that. Because there is a broad consensus that as a nation, we are going in the right direction. As an investor, as an asset class, equities is the place to be in, albeit return expectations could be moderated to the extent we have been hit by the taxes. So that would be my broad call. So I don't really know what to say from August to December, how it will pan out. But broadly, it should be positive.
Sure, Arun. So, from the point of view of investors who may want to kind of, give you allocation, and they have a selection set, rather than giving money to you, they can give money to any PMS also. For a PMS, because a new account gets opened and, concept is there that today when markets are high, for new clients, fund managers may be taking some cash calls and maybe eventually creating the portfolio over 3, 4, 5, 6 month period. But in case of AIF like yours, investor will inherit the portfolio which is already there.
Yes.
So how do you kind of give kind of logical answer to such a investor and pull him to you to an AIF versus such a PMS which maybe is like more appealing to him because he feels that I don't want to inherit the already inflated values of the stocks and I don't want to be into a fully invested portfolio. If you're taking cash call or sitting on cash or there are other kind of perspectives which you may want to highlight.
So see, what the AIF, what it is, right? I mean, anybody who gets our portfolio. That doesn't change. Our investment philosophy, like I said, being a growth-oriented fund, looking at growth-oriented themes. If you've not invested at 100 and investing at 150, doesn't mean that 150 is exhausted. That we've bought a stock at 100 because it is a structural. There's a 2, 3, 4 year story to it, and that's the reason why we invest in a company. And now, whether that investor is getting into an AIF or a PMS, it's the same thing. The PMS will invest in a new stock, which would have gone up 50%. We are already invested in a stock which has gone up 50%. So I don't think that changes. It all depends on how the fund manager structures or what is the philosophy of managing his or her fund. So we still think that AIF is probably a good investment vehicle for most investors. It's also a simpler way to it's a simpler way because the taxes are taken care by the trust and not by the individual investor. So there is a lot of transparency in terms of everybody holds the same portfolio. It's a pooled account. So I don't think there's any disadvantage in looking at A versus B. It's again all depends on what the investment philosophy and the horizon is.
Sure. From the point of view of your clients who are already invested in your product and could be watching this webinar, what is the guidance you want to give on your portfolio at present? Have you thought of doing some tinkering in the portfolio after budget, after elections, in terms of sector stocks, and what is expected in terms of the attributes of the portfolio from here onwards in terms of cash levels, beta, growth in earnings of the portfolio for the investors who are already kind of invested and they want to understand what to kind of expect from here onwards.
Okay, so you asked a lot of variables. Actually, I may not be able to remember it, but I'll tell you. So we actually created a lot of cash in the last couple of months. And we created not because there was an event, because the event, there was a foregone conclusion. I'm not talking about the budget. I'm talking about the elections. So we had created a lot of cash. The fact that the event did not pan out the way most investors did, but ultimately that whole disappointment lasted just one session. That's a different matter altogether. But we did create a lot of cash in months of May to invest in June, which we have done. Now, if you ask me about the changes which we have made to our portfolio, like I said, we have not made dramatic changes. The only changes we have made is that where valuations completely went out of sync. And there were a lot of stocks which we still hold and continue to hold without disturbing our portfolio, where valuations are quite rich. But we are far more comfortable in holding those companies despite those valuations because of the fact that they are companies we believe in, the themes we believe in. There are other companies where we probably will not be able to take that kind of long-term view in terms of saying that, yes, we are willing a company which used to trade at X, now trades at 5X. We continue to think that the company will trade at 5X going forward for whatever reason, because structurally things have changed or whatever. That's could have happened. But we have taken profits there. A case in point is railways. We have actually completely exited one railway stock which we held because it gave us some kind of 6, 7, 8 times return in 12 months. Or not. Thankfully, it was LTCG and not STCG. But so that is something which we have done. Where we have moved to, again, I don't think it's been a lot of it has moved to a different sector or different space. But we have looked at bottom-up names. Some of that has gone to IT. Some of that has gone to chemicals, where we think there's kind of a bottoming out in our opinion. So that has happened. So it's been a very short while, right? About month and a half. So that is a kind of change we have made. In terms of cash calls, we typically don't take cash calls except for that period, like I said, brief period, which we did in May. And we are very uncomfortable with it because ultimately there are so many themes and stocks which are investable. So at any given point in time, I cannot move back and say, no, I will not. I will wait for stocks to correct because those themes will not be valid post elections or post budget. So we have continued to actually invest across the board. Our cash is now slightly below 5% or 5.5%. Ideally, we would like it to be even lower than that. But given the fact that we are getting a lot of inflows, so we have to match inflows with investment, and that's what we are trying to do. I don't know if I've answered all your questions.
No, but I was just maybe one question is that what is the current beta of the portfolio and maybe expected guidance on the.
Our beta has been about less than 0.9. I think it's 0.88 when I last saw it. So it's something which we are very comfortable with. I think it's a good ratio to operate with.
Sure. You also mentioned that you have a fungibility to move from small caps to large caps, but at present you have 40% large caps. But let's not talk about future. But historically, your portfolio I think mostly has 40% large caps.
It's little less than that now, actually. So that shift has happened. I mean, like I said, we look for ideas rather than caps. We are market cap agnostic. It so happens that some proportions, like for example, most of the large caps you own are not Nifty stocks. They are outside the Nifty, and some of them have given very strong returns, and so that's the reason why some of these high exposure. Currently, it's actually come down to probably 35% or thereabouts. Or probably our small and mid has gone up a bit. That's how the ratio is. But broadly, if you were to work with, I think it will be something very similar. It will be 35, 30, something like that.
Sure. One last point, on risks ahead. We kind of should not forget risks, though I know we can't do much because we are long-term investors, and maybe uncertainties, cannot be comprehended also. But there was a lot talk about recession last year in the US, but we don't talk about it. Like I feel really confused. It means that so many, I would say, well-known, famous research analysts maybe have gone and failed in their predictions because there is no talk about recession at all now. It was such a big, I would say, bottleneck or a fear, but nobody talks about it now. So what is the reality of recession in the US, and is that really a risk, or was it like only a fear?
So on a lighter note, we are not so famous, so I don't want to make such take a view and get be proved wrong. So I mean, it's very clear. I mean, we have gone through this entire phase where inflation was at its peak. But the job market was very strong. So, I mean, we'll most probably, as it looks like, we'll probably see a soft landing, and that's what it looks like. But I'm no expert, neither in macros nor in what happens in the US and the rest of the world. As long as I know my job and do my job correctly, sitting here in India, I'm okay. Like I said, I'm not. I don't want to make predictions which ultimately I'll get caught on the wrong foot.
There are two set of questions asked by one of our clients. One, obviously, he wants a confirmation that for NRE investors investing directly in AIF, PIS account is not required.
Sorry, NRE investors, what is not required?
PIS account.
PIS account is not you cannot invest through the PIS account. You have to invest through a normal NRE savings account, I believe.
Right. And yeah, and the second question is regarding the sectors in the portfolio: chemicals, railways, defense.
Yeah, so I told you, railways, we are out of it. I mean, we not that we have a problem with the sector. It's just that we just felt that it was overheated, and given the fact that it is still a single user customer, single customer today. Government is one of the major customers. We didn't want to impute that kind of valuation to that sector. Defense again is a long-term thing. The government, obviously, most of the government companies are sitting on a huge backlog of orders. But again, valuation could be an issue, and whether you can going to beat the same horse, going forward, I'm not sure. We don't hold any PSU defense stock. We have some holdings in private sector defense, but like I said, chemicals is something which we are completely absent in. We have added one name. We think the chemical sector after 2020-21, the run which we saw in 2020-21, there was this major supply shock which resulted in prices going up and a lot of stocking up of commodities or chemicals. And that entire process was reversed starting 21 up to 24, I think last 2.5 years. And that destocking period probably has ended now. We are seeing some kind of offshoots of demand coming evident in evidence, and also given the fact that China, which is the biggest competitor who had come back in the market and actually killed the market, prices have now gone to levels where you probably will see some tick in prices also. So it's very difficult to actually make a call on chemical sector in the true sense. So we are actually again going stock wise. We are picking stocks rather than giving a view on what is going to happen to this chemical or that amine or whatever. I don't know. We're just going by companies which have a track record of managing growth over cycles.
Sure. So though we don't cover stocks, but I leave it to you. It's optional. One of the clients has asked, what's the view on one of the stocks in your portfolio, Sonata Software?
Okay. So, we have Sonata Software. We think it's a great stock to own, not because it's a Me Too kind of IT software services company, because it obviously has a strong relationship with one of the IT majors, Microsoft, and you will see a lot of traction going forward once this whole transition to iCloud starts to accelerate, and I think Sonata is going to be one of the big beneficiaries. Of course, it had the last 1 year, it's had the same problem which most other companies have had, IT services companies have had. Growth traction has been low, has been poor, and because decision making had extended, that is changing now. We are seeing decision making starting to speed up. So you will see Sonata Software get a bit of benefit on that. Obviously, we are seeing that also in the BFSI space. So some investors will choose to invest in companies which are skewed towards the BFSI vertical. We like Sonata for the reasons which you mentioned, and probably there are some other reasons also. I don't actively study the intricate variables of what the growth drivers are, but I broadly know that it's a company which is in a good space and has a good client profile.
So with indexation gone and stamp duty plus interest cost not counting towards the cost of acquisition, will the real estate continue to do well? And if not, would that money move to the alternate assets like equities?
So, I think, okay, I don't know whether real estate will do as well as they did in 22 and 23. Probably not. But structurally, I don't think there is any kind of stress in the sector, or there is not a situation where there was excess inventory or a supply situation where buyers are backing out. Prices are also stable. They are not euphoric. So I think that it all depends on, again, you have to be very selective. I mean, I'm not, like I said, I'm not a real estate analyst here. Our investment in real estate in a couple of names is completely bottom up. We are looking at companies which are one of the companies which is Pan India, which has a very strong franchise and has projects which can generate very strong cash flows over the next 3 to 4 years. It's not done as well as some of the Mumbai-centric or Bangalore-centric companies. It's done well, but we think as long as you are stock-specific and you're in the right company, there is money to be made in the real estate space also. And just remember that I'm not giving this is not a good statistic to go by, but like power, like the power sector, real estate is another space which has seen a prolonged depression over 15 years or so. So once things start to turn, they will turn for a long time.
So we have talked a lot about, tax. One last question, from the chat I'm just taking. Yeah. What is your personal view, the way government has now increased, long-term capital gain tax to 12.5%? This tax was introduced in 2018, and now it's like increased as well. Do you see over the next 10 years going to something like 30%?
No, like I said, I don't think it will. See whether it can go up or not. I think the possibility is that it will go up. Possibility. Whether it will happen in February this next year or whether it will happen in 3 years' time, I don't know. It could go up. But whether it will go to 30% and all is very difficult for anybody to call, right? Because ultimately, government is doing all this is because, like I said, somewhere during a discussion, that people who are able to pay tax are the ones who are paying tax today, because that is the situation in the broader economy, right? And the kind of people you can tax, the kind of people you cannot tax, those kinds of things, and the kind of tax avoidance and things which are going on. But once I think the situation gets to a point where your fiscal situation is situation is so robust that you can afford to pass on some of these benefits to the tax-paying class, the honest tax-paying class. You will see that happen. I mean, I don't think this can go on forever, because there will be, yes, today you can always say that tobacco is taxed at a certain rate. Why shouldn't capital gains? Capital gains is also investing in stocks. Stocks is also a kind of a sin investment. Why should you not do that? But ultimately, that's not the case, right? I mean, they are completely different. There are various classes of investments you can choose from, and equities is globally known to be one of the better investment classes, and especially in growing economies like India, it's probably the best investment class. So I don't think you can keep milking this cow till heavens come home.
Sure. Last question, on Atul Limited, the stock that's there in a portfolio.
What are you portfolio?
It's not there. Okay.
No, it's there, but I thought we bought it recently anyway. Yeah. There's an AGM today. My colleague actually heard it, and he was actually quite pleased with what the management has said. The 2-year vision and the longer than more than 2-year vision. So outlook looks quite okay. I think it looks good. Again, you'll obviously say that it's trading, it's commodity play, and not commodity, quasi commodity. Why should it trade? But see, it's a very well managed company. It's got excellent financials. It's been around for a long time. It's managed growth across cycles, and sector has done badly. When the structure start to move, initially the better managed companies will start to do well, and then it will trickle. If that sustains, then it will move on to the smaller names. So we've actually chosen some of the slightly bigger names to start with.
Sure, Arun. Just for disclaimers, for everyone and anyone who is watching this webinar, few stocks that we may have discussed are all just for our existing clients.
Yeah, absolutely. I mean, I'm not recommending anything.
Yeah, it's only for understanding and learning purpose, and absolutely anybody and everybody who may want to take their own investment decisions on their own should kind of do their own research, or they should hire a SEBI-regulated investment advisor for that. This is an educative forum, and we have kind of done this webinar for our existing clients mostly.
Yeah, ditto. I mean, the disclaimer stands from my side also. I mean, this is a not a personal investment. This is something or a personal recommendation.
Right. Thank you so much, Arun, for this, I think insightful webinar. I think conclusion is that irrespective of market levels, we have to be I would say long-term in our approach, and the budget is more aligned towards growth in the economy, and it is like balancing fiscal prudence also, and that is where it kind of has been cheered by, I would say, investors largely. And it also conveys the focus of government is very clear, and we are already on a progress from say fifth largest economy to becoming maybe fourth and then third largest economy over next 5 years. We have seen India growing to a economy of 4 trillion over last maybe 75-77 years. The same number could be added in next 7 to 10 years. It is like a massive opportunity for investors to create wealth over next 1 decade, and that's the long-term objective that investors need to keep in mind. From that point of view, this budget really kind of reinforces the confidence and belief that we have, with which we had actually set up this entire platform PMS AIF World, and when we had started this forum crystal gazing for next decade, whereby we know that yes, we are in an opportune time, and it's like we need to make right and well-informed decisions. We just not need to be fearful, in approaching equities. Equity as a asset class is very interesting. It needs to be approached with more confidence, and that is where we started doing objective evaluation and doing these, discussions with some of the learned fund managers like you. Thank you so much for sparing your time today for this insightful conversation, Arun, and thank you everyone for joining us for this Friday webinar. Thank you, everyone.
Yeah, thank you, Kamal, for inviting me and allowing me to share my views. And thanks for the summary in the end. I didn't have to do that.
Pleasure.
Thank you.